Good afternoon, everyone. We are just past the top of the hour, so let's go ahead and get started. My name is Doug Skinner. I lead Business Intelligence Services here at AFS. Thank you for joining today's webinar titled The State of Commercial Lending Mid-Year Update presented by AFS. If you aren't familiar with us, AFS has been in business for over 50 years. Our commercial lending platform, AFS Vision, serves as the predominant lending platform in the market today for financial services institutions and commercial banks. AFS maintains a singular commitment to an investment in improving the commercial lending delivery model of leading U.S. banks. You may also be interested to know that AFS, via our hosted private cloud, is one of the largest commercial loan processors in the U.S. And we also operate one of the largest and longest running commercial lending pricing and risk benchmarking consortiums in the US. And most of the data you'll see today is drawn from those sources. So if you'd like information on any of that, please visit our website at afsvision.com. So just a few housekeeping items before we jump into the webinar. The session is being recorded, and it will be sent to all registrants following the webinar. There are going to be 3 live interactive polls, so we'd encourage each of you to participate in those when they come up, and we'll get some real-time insight into how the audience is viewing some of the top-of-the-mind issues. And if you have any questions, please feel free to ask them using the Q&A icon at the bottom of the screen. So we'll try to answer all the questions, but if we don't get to yours, we'll respond via email after the session. So it's now my pleasure to introduce Jeremy Charlson. Jeremy is a senior business analyst in our business intelligence department. Jeremy works primarily with regional banks supporting their pricing analytics and reporting needs. He's an expert in the industry when it comes to credit risk and loan pricing practices in commercial banks. Many of you no doubt already know Jeremy and have been on some of his calls before, and I'm sure you'll enjoy his comments and observations over the next 45 minutes or so. So over to you, Jeremy.
Awesome. Thank you so much for that intro, Doug. And just echoing what Doug said, we're really pleased to be with you today. We know how busy banks are and really appreciate your time joining us today. I think you'll find many of the insights to be giving you some new information into what's driving commercial loan pricing and risk trends. And I see on the attendees list a few of the banks that I work with. So thank you so much for your business and dialing in today. Our focus is going to be on C&I loans in this presentation. Obviously, there's different loan types that we collect here at AFS, but the reason I wanted to focus on C&I was, in many ways, it's been an area of recent strength, both in terms of pricing and credit risk. And I would also say it's one of the more opaque markets, if you will, in terms of really trying to understand the drivers behind it and getting in-depth insight. And so we think that the service that we offer, the pricing dashboard, really provides a nice lens into the drivers of commercial loan pricing. And just to reiterate what Doug said, the trends, unless otherwise noted here, all are sourced from the AFS pricing dashboard. It has great representation across the market. It tracks public sources of information very well, but has the benefit of being able to drill into local portfolios, be it specific geographies, specific industries, and things of that nature. We're really passionate about helping banks transform their lending journeys and revamp their approach to commercial loan pricing. And for that reason, we're really pleased to be offering this webinar. We offer consulting services and, of course, our pricing dashboard to help banks navigate these new market dynamics. Our presentation today, it'll cover 3 broad themes that we feel really are defining the market right now. We'll start with an examination of commercial loan growth. As we know, demand has been very challenging, and we'll try to hypothesize why that is. We'll then analyze trends in loan coupons, spreads, and fees, and dissect that by various categories. And I think you'll see there's a very direct and important relationship between where rates stand today and demand levels from middle market borrowers. And we'll conclude by touching on commercial loan credit risk. I would say that the C&I market in particular has held up remarkably well, despite some of the more pessimistic forecasts. But there are some what you might call hotspots, if you will, certain sectors or areas of the portfolio that we did want to bring to your attention as areas of growing risk. And finally, we'll conclude with a demo of our pricing dashboard product, which is the primary vehicle through which we deliver pricing insights directly to clients. One of the great things about it is you can personalize a lot of the trends that you see here in today's presentation for your specific geographies, industries, and loan types, because of course we know that while there are clear patterns in the market, pricing is very, very nuanced when you drill into deeper subsegments. So before diving into the results, I did want to touch on a few themes that many of your peers have shared with us. As Doug said, we work directly with a wide array of banks of all sizes. And of the clients that I've spoken to, these have been some themes and challenges that have been ubiquitous across those conversations. So the first is that net interest income is under pressure. It's no secret that deposit competition is still very fierce. That's crimping bank NIMs, at least through the second quarter. And what's making it even more challenging is that most banks, not all, but most, have not been able to compensate for that on the volume side. Loan demand has been historically weak. We're seeing that across the country. It's not just one particular area or sector or anything like that. I would say that one reason why we're seeing tepid loan demand is that the loan rates right now that banks are charging on their C&I books are perhaps a bit too prohibitive to revitalize loan demand. So if you recall, following some of the major bank failures that we saw in 2023, regulators really turned up the pressure on banks to maintain liquidity. Banks overall became much more cautious about how and where they deployed capital, and for the most part, prioritize margin over growth. But we are starting to see that sentiment shift. More and more, I hear from all of you, both our client banks and just anecdotal information in the industry, is that the market has turned more bullish on C&I loan growth. We're hearing that bank pipelines are strengthening on expectations that the Fed will cut rates. So it could very well be that we will see some level of turnaround in the months ahead. Now, I think if liquidity was the major concern last year, there's been a much greater focus brought onto credit risk. Now, I know a lot of that discussion is on the office sector or maybe even consumer portfolios, but even in C&I, we are starting to see what you might call some level of normalization where problem loans are starting to rise. And we'll touch on that because, again, if the market does become more bullish on growth, that could possibly erode both pricing and credit risk standards. So these are some of the broad themes that are defining the market today, and we'll try to expand upon them and illustrate them in greater detail with the charts you'll see here. So as we transition into really trying to dissect the C&I loan market, I wanted to start here with a poll from the audience because we all know that loan growth has been elusive, if that's the correct word. And we're curious to hear from you. What do you think is most holding back commercial loan growth? I see the poll just been launched, and the choices that we've offered are sluggish loan demand, high interest rates, possibly being too restrictive, limited credit availability, tight underwriting, and then finally banks prioritizing other asset categories besides C&I or repositioning their balance sheet. So we'll take a moment here to collect information from the audience and see from your peers what they feel is the biggest headwind for growth right now. So hopefully you can all see the poll results now on your screen. So overwhelmingly, the two choices that have garnered the most responses are weak demand from commercial borrowers and high interest rates. That's what I would have selected too if I could have picked one of the four here as well. And I think the reason for that, as we go to the next slide, is those two choices, high interest rates and sluggish demand, are very much related. So here's another kind of survey, if you will, from the Fed Senior Loan Officer Opinions report that they put out, which really gives us some direct input from the field. The blue line here measures demand for CNI borrowers, while the orange series tells us something about bank underwriting standards. So when the lines are below the horizontal axes, it means that demand is weak and banks are restricting the supply of credit. And when you really view this trend over a longer time horizon, you really just see how severe the pullback has been in recent months. And I think there's a couple of drivers here. So the first, going back to the poll, is interest rates, and specifically what's driving the interest rates higher is inflation. So as the Fed rapidly raised rates to try to rein in prices, it caused loan yields to rise and consequently borrower demand to fall. And what this blue series tells us is that many potential business borrowers find that prevailing loan rates are perhaps a bit too prohibitive or restrictive. It's just beyond what they can bear right now, given what their cash flow is. The second factor, though, is supply side. And in the aftermath of what happened in 2023 with Silicon Valley and some other banks failing, many more institutions became more cautious about how and where they deployed capital. In other words, loan growth took a backseat to deal selectivity. That last part is changing. Again, we hear more and more from all of you that banks are, if you will, open for business. They want to lend at least in a responsible manner that minimizes credit risk and interest rate risk, but they are more bullish on growth. The biggest impediment to growth right now is the weak demand, and the demand is weak because interest rates right now are a bit too high. So the high inflation, high rates that many of you have indicated on the poll that we're holding back growth, I think the evidence here as well certainly demonstrates that. So we have another visualization of supply and demand on this next chart. And the gray bars here, these are total CNI outstandings throughout the industry. And notice that trend, those bar charts, how closely it tracks and follows the blue line representing the Fed funds rate. And what this correlation tells us, in effect, is that the Fed's aggressive monetary policy tightening pulled forward demand, if you will, with businesses rushing to borrow before rates had peaked. Once rates settled down, if you look in around the 2023 timeframe, we started to see balances retreat. At the same time, banks became much more risk averse. The industry as a whole became much more risk averse. And so the availability of credit also faltered. So lower risk appetite on the part of banks, coupled with a really exhausted demand from borrowers from what happened in 2022, has made in the present cycle finding new and attractive loan growth opportunities very, very challenging for banks of all sizes. Now, while CNI loan growth for the industry at large is still very much elusive, banks nonetheless were pretty upbeat on their second earnings calls about their prospects for growth and demand in the coming months. And already we're seeing some positive momentum take shape in the market. Total CNI balances have trended upwards year to date when you look at it on a week-to-week basis. That's true for both the small and the large banks, the latter being the top 25 institutions in terms of total assets. Now, the growth was modest, to say the least. It wasn't anything dramatic. It was only about the low single digits on an annualized basis. But bank pipelines hopefully will strengthen on expectations that rates will fall later this year. I think it's important, too, to remember that while loan demand is uneven, broader economic conditions and the broader operating environment is still very, very positive. I think the GDP figure just came out earlier this week that showed the economy accelerated by 2.8%. And charge-offs and other adverse risk events really aren't expected to be a drag on banks' abilities to lend. So already we're seeing some modest, but nonetheless encouraging momentum in the total loan growth trends. Now, within the CNI space, the bilateral loan growth has been particularly challenging, and bilateral here refers to a one bank, one borrower lending relationship, so your typical loan, if you will. And the charts here depict bilateral loan growth indexed relative to January 2023. And really what we're seeing across all four of these charts, which have deal size focuses, is that regardless of what level of the market you look at, bilateral lending has been trending downwards across all commitment sizes. Really, what we're hearing is that CapEx spending and inventory build just hasn't been sufficient to support and sustain consistent C&I loan growth. Note too that competition for new deals is steep. The capital markets and the syndicated markets are very accommodative. Private lenders are eager to put dollars to work, and all of these alternative lenders or alternative sources of financing definitely are headwinds for bank bilateral loan growth. But we are starting to see some green shoots emerge. If I could direct your attention to the bottom right chart there, notice that for the largest size credits, there was a decent uptick month over month in June in bilateral balances. Probably not surprising. These are the borrowers that typically have the strongest risk fundamentals, the bigger borrowers. And in previous cycles, we have seen rebounds in C&I lending start with the larger deals. But for the market as a whole, specifically the bilateral market as a whole, I think much hinges on the Fed's next move, and whether the rates fall by sufficient amounts. Because until pricing becomes less prohibitive, I think a lot of bilateral customers are sitting on the sidelines until until rates fall to more acceptable levels. In terms of loan growth, one of the most important indicators of demand is line of credit utilization. The driver of this metric are complicated, so we've tried to isolate a few of them here. I know the chart's a little bit busy, but what we did with the line series is break out usage by risk grade. And what you can see is there's noticeable peaks and valleys in the utilization trend. One of the key drivers here is inflation, the bars behind the line series. And what really lifted utilization out of the pre-pandemic lows was the surge in utilization, or surge in inflation, rather. So just like we saw inflation driving total balances higher, the same thing happened with utilization rates. They responded very abruptly and quickly to the uptick in inflation. For C&I loans that are risk-rated investment grade, the blue line here, line utilization really hasn't shown much direction over the last year or so. Draws are down year to date for this segment, but so too are commitment amounts. And that may indicate that banks are right-sizing credit lines for this segment of the market. But it's a very different story for the orange series corresponding non-investment grade loans. For these riskier borrowers, line draws are legitimately up quite a bit year to date. This may imply that high inflation, high interest rates are straining cash flow for these borrowers, and they're tapping lines of credit to shore up liquidity. So that could be a potential. It really depends on your perspective. It's good to see usage, even for the riskier borrowers, increase, given that balances have been historically weak. But for risk managers, definitely a trend to continue to monitor as we kind of encounter some more political and economic volatility in the months to follow. Now, here is one of my favorite charts because it's one of the few areas of the market where we're seeing growth accelerate at a very, very rapid pace. The chart here focuses on a very specific subsector, lending to non-depository financials. It's a very diverse sector. It encompasses things like lending to private equity, real estate lenders, and other intermediaries that borrow from commercial banks to increase their dry powder. The chart here tracks growth of that industry, both the cumulative growth rates as the bar series, and then as a concentration measure as the line series. And really by any metric, exposure or lending to these intermediaries has grown exponentially over the last year or so. One of the qualities that makes these borrowers appealing from a commercial bank's perspective is that they typically have very favorable risk and return. What we're finding is that spreads for these borrowers trend above average. There's very few problem loans, very few delinquencies or defaults. And so that could be attracting bank lending to these particular borrowers. I would be remiss to ignore that regulators have expressed some concern about this sector and the indirect exposure lending to these intermediaries creates, whether it's exposing banks to other aspects of the commercial real estate market or leverage consumer credit. But for now, this industry has performed exceptionally well in terms of delinquent loans, and it continues to be an area of very strong loan demand for commercial banks. Another way we can dissect the growth trends is by isolating new loans and renewals. So the new trend here is a bit more of a pure measure of loan demands. It's really showing you new extensions of credit. And if you look on the left-hand side, the originations in June, that was actually the strongest month so far this year for new lending. But on a year-over-year basis, new volumes actually down 25%. So we're seeing some pickup in originations, but maybe not quite what we had hoped or expected just yet. For renewals, May and June have historically represented the heart of the second quarter renewal season. And fittingly, we see renewal volumes spike during this period. You can see on the right chart there, the bars spike up at the end of the time series. But like the trend for new loans, renewal volume was not what we had expected and came in below the year ago levels. Certainly, there's no shortage of competition for renewed business. There's private lenders, for example, eager to put dollars to work. And when we get to our demo today, we'll show you ways that banks can remain competitive in the renewal market without having to aggressively discount spreads to compete. There is kind of a happy middle ground there that we'll attempt to illustrate in our demo today. So we know that higher rates have been a headwind to growth, if you will. But the good news is we are expecting the Fed to cut rates maybe twice or even more this year. I know they're meeting today. I don't expect a rate cut at today's meeting. But curious again from the audience what your expectations are for pricing, specifically the Fed funds rate over the next couple of months. And we put a few choices here to indicate how quickly and extensively you think the Fed will ease rates in the months to follow. That's really interesting. So it looks like the market is expecting the Fed to be somewhat cautious and slow to lower rates. Now, that's probably not surprising. I think what we're hearing is that the economy is still on good footing, and the Fed's going to be cautious about not wanting to stoke inflation again. But at least we are expecting some relief in rates to maybe give some banks relief in terms of both deposits and help revitalize loan demand from the C&I space. Now, speaking of rates, we've been operating under an environment where rates have been high for, quite some time. And what we're seeing here, if you look at this chart here, we're plotting index preferences for banks. And one of the consequences of high rates is that they've made fixed structures less appealing. So for lenders, the Fed's tightening cycle has made them more cautious about interest rate risk and lending on fixed terms. And if you look at the red series here in these distributions, what you can see is that as a percentage of total volume, fixed loans fell from 18% 2 years ago to only 10% in the current quarter. There's also some demand side reasons for that. If you're a borrower, you probably don't want to lock in a high fixed rate now when rates are expected to fall. Instead, the dominant index that we continue to see in terms of loan volume is SOFR, which is the blue series here. That's true for most levels of the market, particularly for larger deals. I would say deals 5 million and up are predominantly tied to the SOFR rate. We are starting to see more banks, though, trying to increase adoption for Prime. Now, Prime has utilized down market for smaller deals, but these banks are trying to increase adoption of Prime for middle market and even for some large corporate borrowers. The reason for that is if you normalize pricing relative to SOFR, so calculate, say, a SOFR equivalent spread, the Prime loans on a SOFR equivalent basis actually display higher spreads than do loans of other flavors. So for banks looking to find additional ways to expand spread income, trying to make greater use of the Prime rate may be one avenue of doing so. As we mentioned earlier, one of the reasons that loan demand has been weak in the current pricing environment is that just rates are, for some borrowers, just a bit too high. And that's corroborated here by another chart from the Fed's Senior Loan Officer Opinion Survey, which is showing here the percentage of banks that are increasing loan spreads sequentially across quarters. What we found is that since at least 2022, banks have been more selective about where they lend and have prioritized margin over simple volume. But with fears of an economic recession having largely abated and banks feeling better about their liquidity positions, more and more banks have turned bullish on C&I loan growth. And in turn, fewer banks are reporting increasing loan spreads from the prior quarter. You can see that blue series there kind of easing as we work our way to the most recent quarter. One client asked me this morning, if more and more banks are pursuing balance sheet growth, what is that going to mean for pricing competition? Again, right now, banks are still exercising a great deal of discipline in how they price fees or how they price loans and how they assess fees. But I think if more banks are chasing limited volume, then I would anticipate pricing competition to, at the very least, intensify somewhat in the months to follow. So let's take a closer look at what's been going on with loan spreads. The chart on the left depicts the loan spreads for loans tied to SOFR. It's the weighted average spread for C&I SOFR loans. And consistent with the Fed survey, you can see that SOFR spreads have trended upwards over the last several quarters. What's fascinating is that SOFR spreads widened even as the base index also increased. And so that means that banks more than passed on the impact of rising rates to their customers. We did see a slight easing in the second quarter, not much. You can see the SOFR spreads came down. Too soon to say whether or not that's a more persistent trend, if we're going to continue to see spreads narrow as banks compete for more volume, but definitely kind of a reversal, if you will, in the usual picture that we're seeing here for SOFR. Now, for prime spreads, we're actually seeing prime spreads narrow overall over the last several years. The average prime spread in the second quarter was nearly zero. And actually, when we break it out by individual banks, we're seeing more and more examples of loans with negative prime spreads. Part of that could be for competition. I think part of that is more there just might be a ceiling on what borrowers can bear in terms of kind of total prime yields. And even from a lender's perspective, if you're booking a loan with a negative spread, a prime loan priced at 750 is still a lot better than 400 18 months ago. So even with a lower negative spread, the overall yield, if you will, on prime loans is still much higher than it was in previous quarters. One of the ways we like to analyze spreads is by commitment size, since it reveals whether banks are making pricing exceptions for certain types of borrowers. So, for example, coming out of the pandemic, we saw some banks pricing more aggressively for the largest loans as they were trying to attract the volume that had the best quality in terms of risk. What you can see here is we still observe an inverse correlation between SOFR spreads and deal size. The slope is downward, but the curve has flattened somewhat year over year. In fact, while banks increase spreads across every deal size range, the biggest increase was observed for the greater than $25 million segment. So these borrowers, again, the large borrowers typically have better risk quality, no longer command the same discount that they did just a year earlier. So it's really another example of how pricing discipline continues to be the dominant story across the C&I space. We also see evidence of continued pricing discipline for fixed rate structures. I know this chart's a little bit busy, a little bit spaghetti-like, but what we did is we took fixed yields and stratified them by term length. And the C&I trends for fixed yields have largely mirrored the slope and direction of the Treasury yield curve, with short-term rates having outpaced the longer-term yields. So that means that in some cases in the second quarter, we're actually seeing loans with over 10 years duration booked with rates beneath those of loans that have less than 1 year term length. The good news is that the inversion implied by this curve, specifically the inversion in the second quarter of 2024, is less pronounced than it was a year earlier. The interest rate difference between the greater than 20-year segment and the less than a year range actually widened over this period. Also, the yield on the 5 to 10 years term length range has outpaced the under 1 year segment and thus is no longer inverted. So still some distortions in fixed rate pricing, but they're showing now a more rational profile, if you will. And again, it just speaks to how banks have really made efforts to improve pricing discipline over the last few quarters. Now, when thinking about the drivers of pricing, things like risk grade, term length, and so on, one that's not immediately apparent is industry sectors. And what we find is that certain sectors just realize higher spreads than others, even when you adjust for collateral and risk factors. So take, for example, the three industries on the far left. These are all finance industries with a NAICS code of 52. And all three of them have a spread above the CNI average. So kind of going back to the exponential growth we've seen in this sector, perhaps again, it's because they're offering banks very good spreads in a otherwise competitive environment. There are some other sectors like utilities on the far right where spreads are very thin, but they do offer other types of structural and risk benefits. But just kind of the diversity in spreads you see across the spectrum here, that's why whenever we onboard a client into our pricing dashboard, we always normalize our reports and our comparisons by geography and by industry, because by these sectors, pricing is just so nuanced and so idiosyncratic. Of course, spread is one half of loan revenue. Fees are the other critical driver. And in terms of how banks assess fees on new renewed loans, so how often they're doing so, that's given you by the Orange series here. That trend has been remarkably consistent over the last several years. It's hovering around 20% or so. We here at AFS do feel there is an opportunity for banks to improve this metric, even when accounting for the fact that banks have seen ROEs improve because of spread expansion. It's interesting that when we deconstruct this trend by bank, typically what we see is that banks that assess fees more frequently tend to do so at lower levels. So there's an inverse correlation there that we observe across individual institutions. For the market as a whole, the weighted average upfront fee level increased year over year, but has been trending downwards as of late. Some banks are trying to manage this decline by offering RM-specific incentives around fee generation, while other banks are still very aggressive in waiving fees and trying to use waiving fees as an attempt to generate volume. So really the practice varies widely across banks, but for banks that can incorporate some market data to measure price sensitivity and price elasticity, we do feel there's an opportunity to improve fee metrics even in a competitive environment. And just like spreads, we see a very clear pattern between fee performance and commitment size. On the left, you can see larger deals are assessed with a fee far less frequently. In fact, for the largest size range, we observe fee incidence of only about 5%, which is very, very low. Perhaps as a matter of policy, banks assess fees more frequently and charge higher levels for commitments under $1 million in size. Notice on the right-hand picture, the gradual uptrend of the dark blue line symbolizing the less than $1 million segment, where upfront fee levels have significantly outpaced the other size ranges. What's really interesting, though, to me in this chart is that if you look for fee levels above $1 million or fees for deals over $1 million in size, there's very little differentiation among the remaining size ranges. This indicates perhaps a pricing opportunity for banks to use market data to better understand price elasticity across size, geographic, and industry segments, because I think banks that can really leverage data to better understand just what is the sensitivity of borrowers to fee levels across those different sectors will have opportunities to have better differentiation and higher fee levels for different areas and levels of the market. So we know that growth has been challenging as of late, and there is some expectation that competition for volume is going to increase, and that, of course, can present some challenges for banks. But maybe taking a broader perspective on the market and even the political or economic environment, we want to know from you what you think your top risks or concerns are for the second half of the year. We listed several options here. You are allowed to select more than one. So, for example, if you think Deposit competition and inflation are the most important. You may select both, but wanted to give you some broad themes for what you feel are your biggest headwinds. And again, we'll give you a few moments to collect some answers there. Wow, it's incredibly diverse that we're seeing in terms of the responses here. It looks like the most important one is actually the election and other geopolitical uncertainty. I'm actually a little bit surprised by that. I would have, if I had to pick one, I would have thought maybe it would have been more inflation or slowing in the economy, but certainly it's interesting. We're hearing, Doug, if you could remind me, there's a new term now, not bull market, but
Oh, Buffalo market.
bull market. Thank you. The term that we've heard recently that says that while the economy is still expanding, it like a buffalo may wander around, and I think the election and some of the uncertainty might be contributing to that outlook that we're seeing here from banks. Almost 20% of you have cited C&I credit quality as being a potential headwind, and that's really interesting because you don't hear a lot about C&I credit quality in the press. Office, for example, and even credit cards are taking up most of the headlines, but we are starting to see some normalization in the C&I space. And so what we've plotted here are trends in special mention loans and classified loans. Special mention being those that may turn into non-performing assets, and classified loans being those where there's been a deterioration in financial ratios or collateral coverage. It doesn't necessarily mean if a loan is designated as such that it's delinquent. It could just mean that the bank is taking a more pessimistic outlook on the borrower or the borrower's industry sector as a whole. But what concerned us looking at this chart was that if you look at the orange series, classified volume is up 50% over the 2-year period ending in June. This is a bit more than what I would call a normalization because 5% classified is actually almost twice that of the historical mean. So there definitely are some sectors in the portfolio that are giving banks some cause for concern. And we can take a quicker look or a more precise look at such sectors on the next slide here. The 10 industries we plotted on this chart all had the largest year-over-year increase in classified volume. Some, like utilities, which is second from the left, had a big increase. Not quite sure. I'm still drilling into what's driving that. It was pervasive. It was more than one bank reporting that, but typically that's a more recessionary-proof sector, if you will. I'm not surprised to see third from the left, truck transportation. There have been higher supply costs, labor shortages that have definitely had a ripple effect throughout that industry. Note too the representation of industries that begin with a NAICS 33 code, which kind of represents industrial and heavy duty manufacturing. Many of these are showing high levels of criticized ratios as well. I recently heard the term micro-recession, which can refer to a condition where a certain sector is having a downturn, even if the broader economy is still very favorable. And that's why it's so important to really understand where these hot spots are emerging, how they might have spill over into other areas of the portfolio, and equally important from a benchmarking perspective, ensuring that if you're seeing a deterioration in manufacturing, that it's at least on par with what your peers are seeing. We'll continue to monitor these going forward. My colleague Tom Cronin does a whole webinar just on credit risk, but we here at AFS are really keeping a close eye on many of these sectors. So really to recap what's been going on through the first half of the year, demand has been unfortunately very weak. And I think the reason for that, as many of you indicated on the poll, is that just borrowing costs right now are too high. Part of the reason for that is banks are still very selective about where they lend. We're still seeing deal selectivity and margin preservation being kind of the dominant themes, but the sentiment is gradually shifting. More and more banks are becoming bullish on loan growth. And I think because of that, there certainly is the potential to see pricing pressures and pricing competition intensify, and even maybe some erosion in credit quality over the next 6 months. So given that uncertainty, we wanted to show you now at the end of this presentation our primary vehicle for delivering pricing insights to banks. Because again, with the potential for competition being heightened because of new politicals and economic uncertainties, being able to track in near real time what's going on for your peers and how you stack up to the market is really, really going to be critical in trying to manage through this new environment. And so bear with me one moment here. I'm going to.
While you do that, Jeremy, let me just remind everybody that if you have questions, please feel free to ask them using the Q&A icon at the bottom of the screen. Also, as a reminder, we are recording the webinar, so that'll be available. I'll get that to you via email, and we'll put it out on social media and our website. So you can look for that in the coming days.
Yes, thank you very much, Doug, for that reminder. This will be recorded, and so you can continue to study that as part of your as you kind of look ahead to the next few quarters. And Doug, just to level set, can you please confirm you can see the demo on your report screen?
Yes.
Awesome. So this tool here, we're very proud of this product. It's our pricing dashboard, and we've been in some form or fashion presenting this product to banks for the last 10 years. It's been undergoing several modernizations and evolutions to make it even more intuitive and more dynamic. But really what it's helped banks to do is to align their pricing tactics with competitive market conditions and really make sure they're closing pricing gaps on new loans and upcoming renewals. And so what we've landed on here is what we call our pricing trends report, which is meant to give lenders and portfolio managers a lens into competitive pricing conditions. So what we do here is we break out pricing trends between a sample bank here, which is light blue, so you can envision your institution in the blue series, and in the market in dark blue. We break out the trends both by index and then by line of business. So you can analyze both C&I and CRE loans. The trends are presented monthly, giving banks very timely insight into how the market is reacting to new volatilities, be it broader economic changes or Fed monetary policy changes. And I like to think of it as a high-level report card for banks and as a way to kind of set a baseline for improvement. So, for example, if I focus here on this top left chart, this shows you trends in C&I SOFR equivalent spreads for the bank versus the market. And notice that for either series, SOFR equivalent spreads have been trending downwards. So again, already starting to see some shift in market sentiment towards perhaps being more competitive with their pricing. But interestingly here, the pricing differential between the sample bank and the market has also widened over that period. And so we can try to see precisely on the rest of these charts what's driving that. So you could then break out your trend for fixed loans, prime, and SOFR, and kind of as you work your way across the top row of charts, you'll see that while the bank is doing well for fixed and prime pricing, there's definitely an opportunity to improve its pricing for SOFR loans. And SOFR is its biggest mover, its dominant index. You can see that here on this bottom right chart, where for your institution, you could highlight your industry mix and track how that's evolving over time. You can see that SOFR is really kind of the biggest driver of the bank's overall trends. Now, one of the ways that I like to use this report is to get a temperature reading on the market, say whether banks are aggressively pursuing new investment grade loans. If the market is indeed going to become more competitive in the months to follow, typically we first see that take shape for the better quality credits. And what I can do in this report is I can select various filters on this report to further dissect the trend. So for example, I can just isolate for new originations. And if I was interested in the investment grade sector, again, I have potentially to filter just for those loans. And the report updates very quickly. And what we see is that the spreads by any index for new investment grade loans, they've all are lower than the market average, not surprising. But the good news is that whether you look at it on a SOFR equivalent basis or track it by different indices, we're really not seeing a dramatic erosion in new investment grade loan spread. So the competition or the flight to quality that we've seen in previous cycles really hasn't taken shape quite just yet. Now, another way that we could personalize this view, we know from speaking with all of you just how important knowing how pricing trends for your different markets is. By that, I mean being able to understand the nuances and the unique competitive pressures by geography. On that same filter menu,
Let's do this. Let's do this, Jeremy. I'm conscious of the time. We're about 10 minutes from the top of the hour, and I know there were some other parts of the dashboard that we wanted to get to as well.
Sure.
While you're doing that, why don't we move to one of the other optimization pages while you're doing that? We
Sure.
do have a couple comments that have come in here, and I'll try to address those while you're doing that. The one was about the slide that talked about the growth in, I think it was the non-depository financials that had kind of bucked the trend. And the question was on, basically how are they performing? And I think the short answer there is really well, from whether it's past dues, non-accruals, PDs, really haven't seen any sign of deterioration there. There was another question on, says any further insight or color into why prime spreads have deteriorated so much. And as you saw, they certainly have. And in some cases, especially with the larger banks, they've gone negative in a number of places. And again, the short answer there is we think it's a lot psychological. So for example, if you were prime minus 50, you're still, or say prime minus 75 even, you're still at 775, which is, a negative spread to prime, significantly above the rate it was just a short time ago. So we think there's definitely a psychological effect there when you start talking about 8 handles. So I see you're on to the next slide one. So we have about 8 minutes. Let's see if we can just give them a quick overview of the last couple of pages here, and we'll see if there's any other questions that come in that time.
Sure, and apologize for the geographic filter. I had some trouble with Zoom that was cutting off my filter pane, but one of the ways that we can dissect trends in this tool is by geography. Again, we know how nuanced pricing can be by geographic regions, and we want to give you some insight into being able to focus on your unique lending segments. One thing we do is really, as we drill deeper into pricing trends, we can calculate pricing opportunities across various levels of your portfolio. So if you look here on this report here, this table is showing you a trend of all of your upcoming renewals. And it gives you a sense for not only what your bank is pricing those renewals, but we can show you the pricing characteristics of these loans, be it, in this case, I've selected the South region. So I filtered just for loans domiciled in the South. You can see other pricing drivers like size and risk grade. And what we do is for every single bank transaction, we find all the other market loans that share those same pricing drivers and average the interest rate. So notice here on this table where you see bank interest rate, next to that is market interest rate. That's the rate based on comparable credit. And that allows us to calculate an opportunity metric, if you will, to say, well, had you been able to price at market clearing levels for underpriced loans, like the example I have here, what is the potential lift in interest rate income? We calculate that value for every transaction, and our machine then rolls up the total opportunity in these boxes here, where you can see had you been able to address all the underpriced renewals that are coming up, if you could price at market clearing levels, you could stand to realize an additional $2 million of interest income. Now, we surface this level of detail not to create additional pressure for the RMs, but more to just arm them with market data to say, how can we improve pricing negotiations? For example, we had a client that told us that let's take this example here, where this renewal is currently priced almost 300 bips below the market average. The RM was actually able to use this information to tell the client, hey, we're giving you a really competitive deal. And they were actually able to leverage this market benchmark to encourage that really important renewal to stay with the bank. We also want to say that even if you could just narrow the gaps for underpriced loans by just a very small amount, the few basis points, incrementally and stratified across the entire portfolio, and that can realize or equate to a huge impact on NIM and ROE. So again, it's not meant to necessarily be an audit tool as much as it is to really empower RMs and help show them how their competitors are pricing new and renewed deals. And then keeping with that same theme, one thing we can do as well is to deliver market data to RMs is to give them some basic pricing scorecards and summaries that summarize insight into where loans are being priced today. You can't always know where your competitor is going to price a new deal, but we do know there are some clear relationships and patterns when you dissect it by size and metric and geography and so forth. And so what I've done here for this particular bank, I've looked at just C&I loans domiciled in the South. And now we have a really comprehensive pricing scorecard that can help banks know or help RMs know what the market clearing levels are for their key segments. So take, for example, the new loans that are $1 to $5 million in size. You can see that rates over the quarter have varied anywhere from about 780 basis points to 752. And so it's really important when looking at market data that you kind of use this as a confidence interval, so to speak, to help ensure that your pricing is still competitive in the marketplace, and you're not pricing yourself out of the market. And conversely, you're not offering a spread that's too low or discounting too aggressively. This report also gives you some insight into credit risk trends. That WAR metric stands for weighted average risk rating. And what it allows us to do is see how risk return is evolving in the marketplace. So notice for this size range how rates and spreads both went up from May to June, but the credit risk stayed the same. And that would imply a widening loan ROE. So we have banks that sometimes will incorporate this level of detail in their pricing models, some that will give this to RM so they have timely and relevant benchmarks to help structure their loan pricing. Again, all tools designed to not only help you investigate broad market trends, but give you some aspirational targets to help nudge RMs towards broader NIM and ROE goals.
Thanks, Jeremy. We have 2 minutes. So again, there's time for maybe another question or two. There is one here that's come in. Any comments on trends in risk migration? For example, do you see movement for the loans rated special mention after a period of time? I believe you had talked about an increase in classified and criticized, but any insight into the ones that go into special mention historically?
Yeah, that's a great question. That's sometimes, for lack of a better word, a holding place for banks if they're not quite sure about the outlook for the borrower. They'll designate it a special mention. We see and we're actually engaged in a risk migration exercise now for our client banks. We see about 30% of special mention loans move in one direction or the other. Half of them of that 30% are upgraded. Something happens where the borrower appears to have recovered somewhat. And the remaining half are downgraded to classified. So of all the risk grades, that one typically sees the most movements. We are starting to see for the market as a whole downgrades accelerate. Again, nothing alarming right now, but the risk migration trends do show that banks are a bit more concerned about the outlook for credit.
Okay. I am not seeing any more questions, so I think we'll use that to wrap this up. So that concludes our presentation for today. As we said, we'll send out the recording and post it to our website. You want to share it with your colleagues. But again, thanks for joining us today and have a good rest of your week. Thank you.